Live from Bloomberg's world headquarters in New York City, we're tracking the key players, the major moves, and the capital flows shaping global markets. This is Bloomberg Deals.
Welcome to another episode of Bloomberg Deals, the only show dedicated to corporate action reshaping markets. On today's episode, defense industry deals take off as the war drags on. In a Bloomberg scoop, Advent is planning to invest as much as $1 billion in defense tech. We speak with the man behind the effort. And despite new uncertainty, Goldman Sachs head of global M&A, Stephan Feldgoise, is still bullish on 2026. Hear why in my conversation with him just moments away. And in today's big deals, SpaceX considering a fundraising target of about $75 billion in its IPO. The company could file the paperwork as soon as this month. For more on this top story, SpaceX, let's go straight to Bloomberg Tech co-anchor Ed Ludlow, who just wrapped up Bloomberg Tech. And I know this is one of the big conversations, Ed. I mean, this has to be the most hotly anticipated IPO in recent memory.
Well, I mean, literally, whether it's by a dollar raise perspective, we're hearing from sources that's now creeping up to $75 billion as the target, or an evaluation perspective, $1.75 trillion valuation, maybe up to $2 trillion valuation, depending on the offering. It is the biggest of all time. And, you know, in line with everything that's happening in private markets, you kind of have this Mag 7 of public markets, but in private markets, OpenAI, Anthropic, and SpaceX chief among them, everything keeps getting pushed up a little bit higher. And, you know, the sense is, confidential filing-wise, prospectus-wise, yes, by the end of this week is what they're on track for. The bigger picture, right, the biggest story is, well, when will they actually pull the trigger and do it and try and go public? And, you know, my sense is from sources, I know Kyle Porter's hearing this as well, we're still on track for June.
Does it make a difference, Ed, of market volatility? Or is SpaceX such a behemoth that they can kind of dictate when they bring themselves to market?
Yeah, I mean, the top line of the banks is interesting. I bet you they're pretty busy trying to keep everyone pretty sanguine and calm. At the end of the day, you have to go back to the rationale of why would SpaceX even bother to go public? Elon Musk has been pretty candid about his attitude towards leading public companies. You know, he's not a huge fan, essentially. It's the capital requirement. They need to raise funds. $50 billion was the original reporting, what they were targeting, now up to $75 billion, because they've changed the business model to be about orbital data center. Whereas previously the mission statement of this company was to make human life multi-planetary, get us to Mars, they basically need a lot of cash to buy the GPUs or chips that go into data centers that come in the form factor of satellites. So timing-wise, that's it. That's the math. And that's why, you know, however they settle the offering, it's the capital requirement that's driving them. And this is a market that is not worried about handing that capital over.
All right, Ed, thank you very much. That's Bloomberg Tech co-anchor Ed Ludlow. Excellent reporting on SpaceX. Let's get to some of the other big deals that we are watching. Joining me around the table is Bloomberg Deals reporter Michelle Davis and Bloomberg senior editor for credit James Crombie. Thank you both for joining. Michelle, let's kick things off with you. You've got the pharma world covered underneath your fingertips, looking at a deal today of Merck buying Terns. What does Terns do, and why are they interested in them?
So Terns is developing a drug for a type of blood cancer, and it makes a lot of sense that Merck is buying this because their best-selling drug, which is also the world's best-selling drug, Keytruda, is coming off patent in a few years. Keytruda contributed like $31 billion, or about half of Merck's revenue last year. So they've been aggressively doing M&A to try to replenish their pipeline. And the thing about Terns is its drug is not yet approved, but analysts say if it does get approved, they expect that it will reach peak sales of several $billion by the end of this decade. So it could dovetail nicely with Keytruda coming off patent. And so the thought is Merck is doing this, you know, as a way to make sure it has all its eggs in different baskets.
It's something that you've been discussing on the show a lot, this idea that we're reaching a patent cliff and big pharma companies need to do something about it. And M&A is a useful route for that. So the deal size, $6.7 billion. Are valuations looking pretty rich as the deal environment really starts to whip up and more pharma companies are looking for replacements?
You know, it's interesting because the premium on this deal compared to where it was trading yesterday was actually 1 or 2%. But if you look at where it was compared to earlier in the year, you know, it was something like 50%. And that's because there is some of this M&A speculation already built into a lot of biotech stocks. And so it'll be interesting to see, you know, how many other buyers follow suit here. We did hear that it was a competitive process, you know, early on, but at the end it seemed like it really was just Merck. Analysts are speculating or wondering if someone else will jump in. That's always the big question. I don't know if I would bet on that.
And James, you're looking at a very different part of the deals universe, and that is the financing for it, specifically in private credit. The headlines and the jitters continue. Where are we seeing the latest pockets of stress?
I think it's a kind of slow burn right now in the BDCs, the business development corporations. Some of them are traded, some of them are not, and retail are realizing that there are limits to what they can get out. They can't just take their money out. They're getting nervous about the exposure that these companies have to middle market companies that, especially software that are being displaced by AI. So they want to get out, and the gates are coming down.
Does that have any impact on the ability, because these funds we've talked about before, they have so much dry powder. Money wants to get put to work. How does some of the gating and the retail redemptions play or alter that dynamic?
Well, the banks are getting nervous and they're pulling back. That's going to make their funding costs higher. We saw one of the BDCs actually get cut to junk earlier this week. So if you're a junk lender, you have to wonder who's borrowing from them and at what rates.
Yeah, the FS and KKR.
That's right.
Right, cut to junk. Thank you both so much for joining. Really appreciate your time as always. That's Bloomberg Deals reporter Michelle Davis and Bloomberg senior editor for credit James Crombie. In other deal news, Estee Lauder in talks to add some European perfume and fashion brands to its portfolio. Bloomberg's Scarlett Fu has the latest. Hey, Scar.
Hey, Danny. Estee Lauder is in talks to buy Spain's Puig brands in a deal that would create a cosmetics giant with $20 billion in annual sales. Now, by bulking up, the thinking is Estee Lauder can better compete against the industry leader, L'Oreal. The problem is the timing is awkward, and that's because Estee Lauder is still trying to execute a turnaround plan that includes sorting out its own brands, from La Mer to Smashbox to Clinique, as well as shifting sales away from department stores to faster-growing online channels. Estee Lauder's latest earnings outlook failed to impress the market, with the CEO admitting that there is still more work to be done. Investors now worry that a potential bid for Puig would add complexity and lead to more spending on stitching together technology platforms and staff, all of which could drag on profit and be at odds with the strategy that Estee Lauder has carefully laid out. Danny?
Scarlett, thank you very much for that. We'll keep an eye on how that deal evolves. Coming up on the show, our investor committee dials in on the defense sector and how the war in Iran is influencing deal-making in defense spending. And later, we're going to talk about another aspect of how the Iranian war is impacting deal-making, energy specifically, with Lande Spottswood. She's a partner on M&A and capital markets at Vinson Elkins. That's all coming up in this hour. You are watching Bloomberg Deals. Let's take a look at the big picture. Goldman Sachs head of global M&A, Stephan Feldgoise, says that he's seeing almost double the amount of deals in the $5 to $10 billion range, a trend he says mirrors M&A cycles of the early 2000s and 2010s. I spoke with Stephan about his expectations for this year.
I'd look back at 2025 as a good example. We went into the beginning of 2025. I'd say the world was generally optimistic about the M&A market. Tariffs came in April, and people were saying a similar thing, which it looks like 2025 is not going to be a good M&A market. And then following April, it turned into one of the most active, if not the most active, second halves that we saw. So it's very hard to predict, but we think in many year cycles. And I always think about, in 2023, I thought about 10 to 15% up market in 2024, and I felt similarly about 2025. I'd say I feel similarly about 2026. The fundamental underlying drivers, so the demands to put capital and invest capital, the desire for corporates to strategically reposition, which really came out of COVID, because coming out of COVID was certainly a period where there were times you couldn't get things done. And coming out of COVID, boards and shareholders said to management teams, if there's something that you think you should do to position you for the next, not 10 weeks or 10 months, but 10 years or 20 years or 30 years, you should seriously think about doing it. And there's going to be periods, whether it be when April of 2025, when tariffs happen, the period after Silicon Valley Bank, that it's going to be harder to get things done. But again, when you think in 1, 3, 5 year M&A cycles, it's not about a given quarter. So overall, still feel relatively optimistic about 2026.
Optimistic enough that it could meet or exceed 2025? Does the pipeline look robust enough for that?
The dialogues certainly do, but I'm a data person, so let's look at the data.
Sure.
The beginning of 2026, and it's really been a tale of two cities. In the $5 billion and up category, it's been, if not the most active year in history. In fact, exceeding what we saw in 2021 in the 5 billion and 10 billion and up categories, which is surprising to a lot of people. Where you've seen a dramatic contraction, we'll talk about private equity in a second, where you've seen a very substantial contraction is in the smallest transactions, down materially. In addition, private equity is down 20+%. Private equity is typically 35 to 40% of the M&A market. It's running at about 24%. So it's a little bit of a tale of two cities, which kind of gets back to that 10 to 15% up year. But in the large transactions, it's pretty dramatic.
How much, especially for those smaller deals and private equity, how much were companies waiting for a window when there'd be lower rates? And the fact that it looks less likely now with inflation concerns over war in Iran, is that altering the outlook?
So I think it's less about sitting around and waiting for rates. But if you take the private equity universe and the monetization, as we've all talked about for a period of time with the substantial number of portfolio companies, it's really about when do valuations reach a point that it's attractive for private equity to monetize. And frankly, they've extended duration. They've had vehicles to tell their investors, be patient, and let's wait and see if there's a better market. Continuation vehicles, other things have provided that vehicle for extending duration to where they're hoping to get to a point where valuations are attractive. So that's a big part of it. And again, whether it's the war that we talk about, whether it's interest rates, it's really about when do valuations reach a point that's attractive for private equity to monetize.
Are we getting close to that at all?
Well, there's two countervailing factors. One is the longer it goes, the more pressure they have from investors to return capital. Valuations, obviously, in certain sectors are doing very well, and we've seen a rotation in capital into what I call steel in the ground industries, where it's less exposed to AI. It's frankly putting steel in the ground. It's food businesses. It's core demand. So we've seen a rotation of capital. So in those businesses, you've seen valuations and you've seen a fair number of transactions. In the ones where it's hard to think about what is the terminal value, which we'll talk about, which is the big question about valuation. We've seen that in software. What is the terminal value? It's harder. And so I think we'll expect to see more.
To that point, are you equally as optimistic about software deals getting done now?
Hard to predict. And I think software is a very big universe, and it's obviously been an extraordinary category for investors in private equity and new company formation. There's still a whole raft of new companies. And if you look back at the internet era in 2000, many of the winners didn't start until many years after that. So we're just getting into that. So I think there's going to be new company formation. There'll be some natural transitions. Obviously, the impact of AI in that entire universe is to be seen, but it's clearly having an impact on valuation.
What about the impact of AI on the entire corporate universe? You know intimately well CEOs' boardrooms. Are they prepared for this moment? Do they have the expertise to guide them through it?
So it's really interesting. If you look at some of which were crises and some of which were just business developments, COVID, you had health experts in the boardroom who could talk about the impact to society, the impact to customers. The financial crisis, you had lots of ex-CFOs sitting in boardrooms who understood credit and understood what it meant to have a credit cycle. AI is really the first, what I'll call, impactful situation. For some, it's existential. It's obviously going to have a big impact on everyone, where there's not a history of experts sitting in the boardroom. So it's really hard. It's not that anyone did anything wrong. It's just it's exploded in terms of its impact. There's really not a lot of history. And so boards and management teams in all industries are grappling with, all right, who are the experts? How do I get expertise to think about, how do I think about business planning? How do I think about doing M&A? How do I think about setting up my company? Where do I invest? And so all that's going on right now. And so it's not necessarily just an M&A dialogue. It's really a dialogue about how do you build, run, and do M&A for companies and for boards.
Stephan, before you go, we have to spend a moment with private credit, because it is a moment where it has been dominating headlines of redemptions, of calls for certain amounts of defaults. Are you concerned about this key pillar of financing for deals, that there could be a scenario, if some of the worst of predictions come true, that a key area of financing starts to dry up, or at least liquidity starts to become more thin?
Yeah, I start with the foundational piece that there's incredible amounts of capital sitting with investors. Public equity, public debt, private debt. That quantum of capital is substantial. Looking to invest into transactions, into companies. There's lots of ways that that capital can reach its destinations. Syndicated financing has been around for a long time. It hasn't gone away with private credit. It still remains very viable. Private credit was a vehicle and a pathway for capital to get invested into situations. So the vehicles in which capital may invest may ebb and flow depending on markets or depending on redemptions or depending on all the things that you described. But intrinsically, as you think about over periods of time and over cycles, tremendous amount of capital looking to invest in great opportunities. That's not going to change. As long as you have that desire of intrinsic and basic capital to get invested, it's going to find the right vehicle which the market is supporting.
Our thanks to Stephan Feldgoise, and you can watch that full interview on Bloomberg.com and on the terminal. Coming up, Stephan just mentioned private equity, and we're going to go further into that space next. Joining us is Shonnel Malani, managing partner and global head of aerospace and defense at Advent. We reported this morning his firm is planning to invest as much as $1 billion in the defense sector. He gives us the details next, right here on Bloomberg Deals.
I'm Norma Linda. Let's take a look at your midday movers. First up, U.S. stocks are climbing as traders weigh the viability of ceasefire talks between the U.S. and Iran. Wall Street is parsing a diplomatic push by Washington to end the war, even as Iran says it does not accept a ceasefire. Oil prices are falling on hopes of easing supply disruptions. In corporate news, ARM shares are on the rise after the company said it plans to start selling its own chips, with Meta lined up as the big first customer. ARM is betting this new business will eventually outpace its current operations and says it could drive total revenue to about $25 billion within 5 years. That's roughly 5 times where it is today. And speaking of Meta, the company is cutting several hundred jobs as part of a broader restructuring affecting teams across sales, recruiting, and its Reality Labs unit. The layoffs will hit employees in the United States and overseas, with some workers being offered other roles or the option to relocate. And finally, U.S. space and satellite stocks are moving higher. Bloomberg News reporting in the last hour that SpaceX is considering a fundraising target in its IPO of around $75 billion. Names like AST Space Mobile, Rocket Lab, and EchoStar are gaining on the news. Those are your midday movers. I'm Norma Linda.
You're watching Bloomberg Deals. I'm Danny Berger. Time now for Alternative View, where we focus on the latest trends in alternative investing. Today, PE and defense. A story we broke this morning, Advent is planning to invest as much as $1 billion in the defense sector as global tensions rise, according to a person familiar. Joining me now is someone who's very familiar with that. It's Shonnel Malani, the managing partner and global head of aerospace and defense at Advent. Shonnel, thank you so much for joining. So you've already spent $15 billion in spending in defense and Advent since 2020, but this is specifically targeted towards next generation defensive tech. So why $1 billion and why this push now?
Well, the world has been changing, Danny. You see, for the last decade or so at Advent, we have been tracking technologies which state actors have been using to leapfrog each other. And that's created a little bit of a race to better technologies and created overmatches and gaps. And we have been trying to invest in these strategic areas in order to close these gaps as we go on. And I actually think there is a true role for private capital to play in closing these gaps as we go forward. So as you said, at Advent, we have since 2020 deployed over $15 billion into mature defense companies to help them innovate. And now the idea is to commit up to another $1 billion to help the innovators mature.
That's what I wanted to ask specifically, because I think of Advent and I tend to think of larger cap deals. Shonnel, are there larger cap deals to be done here? What are sort of the companies and the ticket sizes that you would be looking for? Is this almost more, let's say, growth or VC style investing?
Well, it's both really at Advent. So historically, we, as you rightly point out, have been larger cap investors. So we have done take privates in the $5, $6, $7, $8 billion ranges, and we have aspirations to do even bigger things. And the idea there is to take these very mature businesses and see if we can instill a bit of innovation and bring them into the next generation. This specific area is actually to do something else, which is we've come across a host of these highly innovative next generation disruptive technologies as we've tried to partner with them strategically with our mature portfolio companies. And this is an opportunity for us to invest directly in some of these companies and help them into the next chapter of their growth.
So it's already the world, Europe, we've been experiencing war, first with the war in Ukraine and now a new battlefront in Iran. You mentioned some of the gaps, Shonnel. What are those gaps that you'd be looking to invest in?
Well, the gaps are stemming from what I said earlier, which is this technological race for military superiority that is ensuing. So far at Advent, we have made an investment in Cobham, which has largely been around missile defense. We've done Ultra, which was for the most part submarine hunting. Maxar, which is now called Vantor, and that is around space-based intelligence gathering. And most recently, Attilon, which is a carve-out of the old coherent aerospace and defense business, which is for the most part going after anti-UAV laser weapons. And the underlying and cutting across area across all of these is to innovate them through autonomy and AI.
There are also reports of you not just buying, but also exploring exits for some of your defense assets. Ultra Maritime business. Airbus also recently agreed to buy Ultra Cyber from you. Along with the opportunity for buying, is now also a really ripe time to be exiting, again, given the geopolitical environment and concerns about war and where those gaps exist for different countries?
Yes, absolutely. Look, we are at the end of the day investors, and as investors we have a fiduciary duty to make sure that we are making good investments. So this is an opportunity where we find some of our companies that we have owned for 3, 4, 5 years already, and we have broken the back of what we wanted to do in terms of leapfrogging them into the next generation of technology, like Ultra Maritime, where we've taken a legacy submarine hunting business and deployed AI and autonomous solutions to it. It's a great moment to sell. Now, it is a precarious time, and so we're very conscious about who we sell to.
On that as well, it's sort of along the similar lines, and only about 30 seconds here about Shonnel, but how has it looked cooperating with governments in Europe, in the US? Are they on board? Do you need to see more from them as you go along this venture of investing more in these companies?
Yes, look, governments and regulators have an enormous role to play here, right? Defense companies can innovate all they want. We can come up with very exciting new technologies. But these technologies, in the end, need to be procured and need to find their way into the hands of the warfighters. And that's where government and regulators play a role. The procurement engine in defense is notorious for being very slow, very clunky, taking an enormous amount of time. And I think we have the opportunity here to ask them to do it faster. And there is a very clear impetus from the top, pushing for us to be more efficient. And we are excited to follow up on that.
Shonnel, thank you so much for joining us. That's Shonnel Malani of Advent. More coming up next on Deals. Welcome back to Bloomberg Deals. I'm Danny Berger. The defense industry is assessing the cost of modern warfare and taking into account new drone technology. One estimate sees global demand for unmanned systems to reach $26 billion by 2030. Just yesterday, Bloomberg spoke to the Andreessen chairman and co-founder Trey Stevens at the Hill and Valley Conference in Washington about defense tech.
There is a big story that has emerged around the asymmetry in drone warfare that's taking place with Iran, where they're lobbying drones that cost tens of thousands of dollars, and we're countering them with capabilities that are upwards of several millions of dollars per shot. So one of the goals that Andreessen has had since the very beginning when we started the company in 2017 is to significantly lower the cost of engagement. Right. And that's using low-cost munitions, using low-cost interceptors.
Let's go to Scarlett Fu, who's taking a closer look at drone companies. Scar.
Hey, Danny. These firms are really on the front lines of defense tech. And with ongoing conflicts in the Middle East and Ukraine, there's renewed investor appetite for new names in the space. So let's start with AVEX, which this week filed for an IPO on the New York Stock Exchange. The PE-backed military drone maker gets a big chunk of its revenue from Ukraine. And while it currently is unprofitable, AVEX is committed to delivering $1.2 billion of sales through the end of this year. There's also Swarmer, which makes AI-powered drone software. It had a blockbuster debut this month. The share surged almost 1,000% in the first 3 trading days alone before pulling back. And some investors may follow Don Trump Jr. and Eric Trump's lead. The president's sons have backed at least 3 drone companies, all based in Florida, since 2024. A fund that both sons are partners in has stakes in Paris, X10, and Unusual Machines. The stakes are worth almost $750 million. At a time when the U.S. government is prioritizing arming U.S. forces with drones and issuing contracts, valuable contracts to do so as well.
Scarlett, thank you very much for that context. And that brings us to this week's Investor Committee. On this week, it's all about defense investing, and we take you into the boardroom debates in real time. Today's Investment Committee, it is Ian Fujiyama, head of Aerospace, Defense and Government at Carlyle, Mark Marengo, global co-head of Diversified Industries Investment Banking at JPMorgan, and Erin Price-Wright, general partner at Andreessen Horowitz, who also looks at the sector. Ian, I want to start with you because Carlyle is the only firm of its size that actually has a dedicated aerospace and defense business, and you've been doing it for decades. So what would your pitch to the ICB? What is the most attractive area to invest among defense companies?
No, thanks, and I want to say thank you for allowing me to be here today. It's a pleasure. It's definitely a dynamic time for our industry. In our 35 years of doing this, we haven't seen more opportunities. As you think about defense spending here in the U.S., it's roughly $1 trillion, but that still represents roughly only 3.5% of GDP, which is near a 70-year historic low. And so now as we're pivoting from counterterrorism to great power competition, the need to do things better, cheaper, and faster has never been more urgent. The problem with the industry is that we've gone through a period of immense consolidation. So you have a hyper-barbelled industry led by and dominated by the large primes, and then a very hollowed out middle, and then there's innovation happening, but at a much smaller scale.
So you're looking mostly at the innovation then? Is that where the most
We think the opportunity would be to help rebuild the mid-market because you need the capability, but you also need the scale and the ability to grow to make it relevant for the warfighter.
Erin, let me take this to you because, of course, at Andreessen Horowitz, you're going to be looking at maybe more of the more younger innovators that Ian maybe would sort of pick up along the way. So what would be your pitch? What do you think is the most attractive area of defense right now?
Well, if we want to be prepared to protect and defend our country, we have to be producing at scale for cost that is reciprocal to the cost of the weapons our enemy is using. So we can't be shooting down 40K drones with a $3 million single-use missile, and we shouldn't be putting the warfighter into harm's way when autonomous systems exist to help get the job done. Where we're really excited, though, is the supply chains up and down the stack. So you don't have a defense industrial base without an industrial base. And the current state of the defense base is making us realize how much work there is to do to build out these supply chains up and down. If you look at the situation in Iran, we're desperate for low-cost systems with embedded intelligence. But when you're shipping drones, interceptors, missiles at high volume with all these autonomous features, and you're iterating on designs from one week to the next, we're starting to ask the question of where are we getting motors for those drones? Because we don't manufacture those motors in the U.S. today. Even the materials that comprise those motors, copper, steel, magnets, right now, the majority of these supply chains run through China. And if you think about even all the electronic systems on board, you're iterating quickly on these components. We don't have a massive supply of electronics and electrical engineers to be able to do that work. So how are you even iterating at that design speed? So where we're really excited is just seeing this huge explosion of opportunities and incredible founders who have grown up in real manufacturing companies like SpaceX, Anduril, and even Palantir, and are starting to move down to the stack to some of these more industrial problems.
Mark, let me bring you in because, of course, you're overseeing the aerospace and defense portfolio for the $1.5 trillion of JPMorgan Security and Resilience Initiative. Where do you fall in what is the most attractive area to be investing in?
Yeah, and look, I think Erin touched on this. Supply chain and critical rare earth minerals is a very important part of where we're seeing a lot of the opportunity. When you consider that 80 to 90% of the rare earths that we use in our defense products today are sourced overseas, there's a big gap in our supply chains. And so we've been spending a lot of time, in many cases in partnership, public-private partnership with the government, looking to develop solutions to solve for and bring a lot of the rare earth processing capability back to the United States, right? We saw that in the MP Materials deal. We saw that in the Korea Zinc deal. And both of these are examples of deals that I don't think would have happened without the government, industry, and the financial community locking arms to develop a bespoke solution to bring those capabilities back. The other area, when you look at the platforms and you really dig deep into the supply chain, what you'll find is as you get below the tier 2s and the tier 3s, it starts to get very, very fragmented. And you have many smaller companies who may not have the capital or the resources to expand capacity, modernize in order to hit the increasing production rates that are expected of them. And so we're spending a lot of time focused at that level of the supply chain, making sure they have the resources in order to deliver on the mission.
So we're running up against a little bit of hard time, and I want to get some more in here because Ian, Mark there was talking about the importance of public and private partnership, and you're based in the heart of this. You are in Washington, D.C. How does that look when you're thinking about investing? Is that more risk or is that more opportunity with working with the government?
Yeah, so we've been navigating the regulatory framework for 35 plus years. It's definitely something to be cognizant of. It does benefit us in some ways that a lot of our peers just don't focus on this area because it is too complicated. Those that we do compete against tend to be more mid-market firms, which as a global private equity firm with our global footprint, with the resources we have, it's easier for us to differentiate when we're looking to court a founder of a business that he should partner with us. And so, there are some opportunities as well as risks with regard to regulatory. I'd say one of the big changes, and Mark alluded to it, is the real change in the administration. Some of the deals that they're putting forward are truly innovative and things that we would not have even imagined.
Yeah. Erin, how are you thinking about the regulatory risk in the sector?
There's risk and there's also opportunity. I mean, a lot of our companies are building physical things. They need to build factories. They need power to do that. They need land. They need permission to do that. And a lot of building physical things is really an alignment problem, and it involves working with the federal, state, and local governments and local communities to basically get the permits and approvals needed to actually build something and the capital required in order to do it.
Right.
So one thing we're really seeing is in our portfolio companies, we're working with governments, state and local governments, as well as the federal government to be able to build real projects. Our new centers of excellence popping up kind of outside the traditional tech hubs, which is pretty exciting. And what we see is that once a region makes itself known that it's open for business and that it wants to work with the federal government, that it wants to work with the military, and that it wants to work with these startups, it starts to create an ecosystem, a talent pool, process knowledge that attracts the next businesses to the area. So we're starting to see that play out in regions like Texas, Ohio, Arizona, that are really becoming the next generation of defense industrial base in partnership with both private companies and the federal government.
Mark, I just wonder, look, this conversation itself highlights the fact that there is demand for these types of deals and for these types of companies. What do valuations look like right now?
It's interesting. I used to say, having covered this space for a long time, that all defense is treated equal, meaning that historically you've seen defense valuations trade in a relatively tight range. Now, what you've seen is in the current environment, there's a pretty wide disparity in terms of valuations. You have the large caps that typically trade in the mid-teens on a forward EBITDA basis. You've got the platform agnostic mid-cap defense suppliers that are trading in the, call it high 20s, low 30s, and that are projected to grow high single digits on the top line for the next couple of years. And then you have this emerging group of defense tech and space tech companies that are trading at 40, 50 plus times EBITDA and are projected to grow it at 20 to 30%. And so the valuation paradigm has changed dramatically, which has really created an opportunity for public market opportunities. So IPOs, for example, we saw 3 defense IPOs last year that raised a little over $2 billion in North America. This year, we've already seen 1 in North America. We've seen 2 in Europe. Our pipeline of IPOs for defense and defense tech companies has never been as high as it is today.
Well, Ian, sorry for jumping in, Mark, but I only got 30 seconds here. Ian, I would love to get your view on this is our IPOs a good exit opportunity for these deals you're looking at? And apologies, just only about 30 seconds here.
At the size we play at, IPOs are definitely an option. We look at things across our portfolio, and there are a number of candidates. We recently took one company public just a year and a half ago. So strategic buyers are generally our preferred route, and we try to tailor make our businesses to be more desirable by strategic buyers. But if we can hit an IPO window for the right opportunity, we're absolutely happy to do that.
Well, Ian, you have to come back when you have an IPO and come talk about it on Bloomberg Deals. Thank you all so much for your time. That's today's investment committee. Ian Fujiyama of Carlyle, Mark Marengo of JPMorgan, and Erin Price-Wright of Andreessen Horowitz. Now to some breaking deal news. We're hearing something about JetBlue. Scarlett has the details. Hey, Scar.
Hey, Danny. Yeah, JetBlue shares are surging right now, up 15%. Semaphore reporting that JetBlue has tapped advisors to assess the viability of selling itself to a rival airline. And it has specifically scenario planned for how a deal with United, Alaska, or Southwest might be received in Washington. It's not clear if the company has held discussions or received any indications of interest. But of course, you'll recall that JetBlue tried and failed to buy Spirit Airlines back in 2022. We'll continue to keep an eye on these headlines. This is Bloomberg Deals.
We're just about halfway through the trading day in New York. I'm Norma Lande. Let's take a look at your midday movers. First up, U.S. stocks are climbing as traders weigh the viability of ceasefire talks between the U.S. and Iran. Wall Street is parsing a diplomatic push by Washington to end the war, even as Iran says it does not accept a ceasefire. Oil prices are falling on hopes of easing supply disruptions. Also over in crypto markets, Bitcoin is bouncing back after Tuesday's drop as investors step back into risk assets. Crypto-linked stocks like Coinbase and Circle are also moving higher in sympathy, tracking that rebound in digital assets. And finally, over to the headline Scarlett just mentioned, JetBlue shares are flying high for double-digit gains after a Semaphore report that the airline is considering the option of selling itself to a competitor. The U.S. airline has reportedly hired advisors to explore the viability of a deal and is considering scenarios of a tie-up with United, Alaska Air, or Southwest Airlines. Those are your midday movers. I'm Norma Lande.
Welcome back to Bloomberg Deals. I'm Danny Berger. Saudi Arabia and Kuwait are attempting to press on with multi-billion-dollar energy deals. That's despite a widening conflict that's seen Iran target oil and gas infrastructure across the Middle East. Let's take a closer look at the energy sector and deals there with Lande Spottswood. She's partner M&A and capital markets at Vinson and Elkins, and she has advised on more than $500 billion of M&A transactions with a focus on energy. And she joins us now for Premium Players. Lande, thank you so much for joining.
Thank you for having me, Danny. It's good to be here.
This is a sector that, again, you know extremely well. You've seen a lot, but this time around, it's oil prices that have been extremely volatile, jumping from above 100 on Brent to below. Well, what has that shift in volatility done to M&A markets?
I think the key, if I was trying to sum it all up in one phrase, volatility in energy M&A, practice has made perfect. We've had a lot of practice with volatility lately, and deal makers have gotten used to it, and they've started to move through it. I think that cash deals for upstream, you're just not going to see those get announced relatively soon. I think when there's an expectation we'll know more about the future strip 2 weeks from now than we do now, you're just not going to see people pull the trigger. But I do think talks are continuing. I think activity is going to continue, and volatility is the new normal.
Does it, though, make it difficult to agree on a price if the underlying commodity is moving around a lot?
It does, and particularly a cash price, right? And so if I was in Midland last week and talking to clients who are kind of pure play Permian producers, and they've seen a lot of assets get pulled that were in the market. We've seen that with processes we're working on, because it's just hard to agree what something's worth when you don't know what the price is going to be a year from now, 2 years from now. And, you can just wait and see. If this continues the way it has, and there's just uncertainty about when the strait's going to reopen, I do think that deal activity will continue, because that's what all the macro is pointing towards.
And to your point, we're used to that. We know how to handle volatility. But if the net impact, even if this war were to resolve itself in a more timely fashion, there's been this expectation that oil and energy prices settle just at a higher rate because it takes a while to restart oil fields, that we know that there's this risk that exists. What change would that mean to see oil just structurally settle at a higher level from here?
I think that would be gangbusters for energy M&A. And I do think that's what we would expect if you see this resolved in the next month or so, without too much more long-term damage to assets in the Middle East. And so what you would see is prices reset, maybe closer to where they are now on the forward curve. And that would make energy companies healthier. It'd make them more willing to invest, stronger balance sheets, buyers more aggressive, and all the long-term macros towards consolidation.
So a lot of the oil majors, Exxon, Chevron, some of the shale producers like ConocoPhillips and Diamondback, they've done acquisitions. Have they fully digested those? Are you seeing the pipeline? Are they ready to come back for second bites?
This is a year where, yes, I think there was a lot of large-scale M&A that got held up too long in the FTC during the last year of the Biden administration. Those big deals are starting to be fully digested. And what people sometimes don't remember, if you're not in this space every day like I am with these energy companies, is they're in the business of selling their assets every day. And so you have to constantly be thinking about the next place to grow, or you're going to get smaller. And so I do think they're ready to do more deals if you can find the right one.
Yeah, to that point on the regulatory landscape, I mean, Scarlett was just talking about news coming from Semaphore that JetBlue was looking at maybe combining itself, different from your world, I realize, but it's a deal that they had attempted before and couldn't in the Biden administration. What has the regulatory landscape of having a more deals-friendly type of administration done to the energy patch?
I think we've seen it in two ways. One, I think it's a regulatory environment that is much more friendly towards development generally, the building of large-scale infrastructure in a way that the Biden administration wasn't. So I'm seeing clients deploy capital towards building big projects, big pipeline projects, big data center that maybe isn't M&A exactly, but it's definitely, taking advantage of a different type of regulatory environment. On the antitrust side, I think there's two big differences. One, I think there was some just general political overlay that was negative for consolidation in the energy space. During the Biden administration, there was a lot of inflation concerns. People were focused on gasoline prices, and they weren't
Don't
friendly.
We still have that, though? Isn't this administration really concerned about gas prices and affordability?
Yes, but what I was going to say is it wasn't always deals that were going to actually impact gasoline prices that were being focused. We would see some natural gas combinations that, I think your viewers are sophisticated enough to know that natural gas mergers don't tend to impact gasoline prices, but it makes a good headline if you're trying to play politics. So we've seen less of that. There's not going to be that. And there's also just this administration, I think, has less sincere cynicism about scale generally. I think under Lina Khan, there was just this discomfort with big, even if there wasn't a clear competitive problem that could be pointed to in a deal. And I think there's less of that here. And I also think there's a desire to move faster in getting things through. So I do think it's a friendlier antitrust world to do large energy deals than it was 2 years ago.
Lande, this has been so fantastic. You have to come back and join us soon.
I would love to come back. Thanks for having me.
Really appreciate your time. That's Lande Spottswood, partner M&A and capital market at Vinson and Elkins. Coming up, Blackstone makes its first investment in sports. Maybe not where you'd expect. Scarlett's going to have the details next. You're watching Bloomberg Deals. Welcome back to Bloomberg Deals. I'm Danny Berger alongside Scarlett Fu. No, not the NFL, NBA, or MLB. Blackstone's first investment in sports is cricket. Blackstone joins a consortium to buy Royal Challengers Bengaluru, the reigning champions in the Indian Premier League. The purchase comes at a $1.8 billion valuation, and Scarlett is here with me on this. I gotta say, husband-in-law and husband-in-law's family is British. The family group chat was lit about this deal that's coming from Blackstone.
Pretty incredible, because the Indian Premier League is the world's most profitable and popular cricket league around. So, good reason for it to be lit. Basically, this is a league that runs for 8 weeks every spring. It combines high-stakes cricket with U.S. marketing savvy and Bollywood glamour. So there's a lot of star-studded power here. The investment here that Blackstone is making is through its Blackstone Private Equity Strategy Fund, which is for wealthy individuals and allows Blackstone to hold stakes for longer than it normally would.
I was surprised this was Blackstone's first sport investment.
I know. Yeah, Carlyle has moved into this space, as has KKR, but, they took a while and they found a good one.
Yeah. Yeah, they found cricket. I mean, it is a very beloved sport worldwide. Scarlett, thank you, and thank you to everyone watching. That does it for Bloomberg Deals. To stay up to speed, even after this show, subscribe to the Bloomberg Deals newsletter. Up next, it's Balance of Power, live from Washington.